In this video, I'm going to give you an overview of the inventory management process. Note that the process is a little more complicated for a manufacturer like Caterpillar than it is for a retailer like Walmart. And the reason is that a couple of the steps that are in the process for a manufacturer are not going to be part of the process for a retailer. And that's because a retailer does not manufacture its own inventory. A retailer like Walmart purchases inventory that's been manufactured by another company like Procter & Gamble. So a retailer is acquiring inventory that has already been built or constructed and then turning around and selling it at a higher price than they paid for it. Whereas a manufacturer is building its own inventory. So, basic overview of the steps. The manufacturer is going to order and receive raw materials inventory. Then they're going to put those raw materials into production and manufacture the inventory, store it until it's ready to be shipped or delivered to customers, and then make sure that they update the inventory records at all points throughout. Whereas a retailer, they're also going to start out by ordering and receiving the inventory, but remember, they're going to receive inventory that is already finished. They're not going to get raw materials inventory. So they're going to get finished goods. They're going to store the inventory, ultimately ship or deliver it to customers, and again, at all points throughout, they're going to need to make sure that they update the inventory records accordingly. So let's dive into this in more detail, covering each of these steps. Okay, so step one, ordering and receiving raw materials if we're talking about a manufacturer, or finished inventory if we're talking about a retailer. So how does a company determine how much inventory that they need to order? Well, it all starts with the sales forecast. So the marketing department is going to prepare a sales forecast and say, hey, here's what we think we're going to sell in terms of the number of inventory units. And then a manufacturer would then take the budgeted sales and use that to say, okay, now let's figure our production budget. Once we know how much inventory we think we're going to sell, we can say how much inventory we need to produce. And then from the production budget, the manufacturer can make other budgets like the raw materials purchases budget, the direct labor budget, and so forth. Now, a retailer is not going to be producing inventory, so they're just going to have an inventory purchases budget. But again, it's going to be based on the sales forecast. So first, you try and predict what you're going to sell, and then you say, okay, how much inventory do we need to buy or produce? Now, once you know how much inventory you think you're going to need, you make a purchase requisition. So the company would say, okay, look, we're going to basically request that we get X number of units of inventory or X number of units of raw materials. And then the purchasing department for the company would then go and submit a purchase order to an approved vendor. Now, I'm not going to go through the purchasing process in detail because I already have another video on that if you want to learn more about that. Okay, so got the purchase requisition, say, hey, look, this is the inventory we need. Purchasing department submits a purchase order to the vendor, and then at some point, the company actually receives the goods. Raw materials if it's a manufacturer, finished goods if it's a retailer. And they would verify the quantity and quality, make sure you got the right goods, the right amount of goods, and then prepare a receiving report saying, okay, here's what was actually received. So that's the first step of the inventory management process. Now, you've got the raw materials, assuming we're talking about a manufacturer here. You've got the raw materials, and they're just sitting in the raw materials storeroom. And at some point, you say, you know what? Actually, we're going to fill out a materials requisition form over here in production because now we're requesting that the raw materials, some of them be moved from the storeroom into production. When that happens, you're going to decrease the raw materials inventory and increase work in process inventory. And again, this would just be a manufacturer because a retailer does not have raw materials inventory. They have a finished product that they bought from a manufacturer. So remember, manufacturers have three types of inventory. They start with raw materials inventory when they receive the raw materials that we talked about before, the receiving report and so forth. But then once they start working on the raw materials, they start doing some work to it, right? So we're talking about Boeing using aluminum to make an airplane. If we're talking about a home builder using wood to build a house, right? Once you start taking a hammer and driving some nails into that wood, you have work in process inventory. That's what I have abbreviated here. WIP is work in process. So a manufacturer would initially record raw materials inventory when they get that raw materials, but then when they put it into production, then they're going to decrease raw materials inventory and increase work in process inventory. The final type of inventory is finished goods, which we will get to momentarily. Okay. Now, step 3, manufacturing inventory. Obviously, a retailer is not going to have this step because they don't manufacture their inventory. But for a manufacturer, the product might pass through various stages of production. There might be multiple different production departments, and ultimately, when it's fully done, when you're like, okay, now we have the inventory has been built, there'd be a production report generated, and that would record the completion of the finished goods. The company would reduce its work in process inventory account once it's no longer partially completed and it's actually finished, and increase finished goods. So when you finish the partially completed inventory, decrease work in process inventory, increase finished goods inventory. Now, as the product goes through each department, there should be authorization required to make sure that there is no unauthorized production. And these manufacturers, so they're going to be adding, each time it goes to a different department, there's going to be conversion costs. Okay, because remember, you got the cost of direct materials, right? The materials being used, but then you also have direct labor and manufacturing overhead. These costs are not in the raw materials inventory, but once you start working on it, get to work in process inventory, you're adding direct labor costs and manufacturing overhead. So these costs are going to be added as the inventory is manufactured. Now, once the inventory is built, if we're talking about a manufacturer, or once it's received, if we're talking about a retailer, these finished goods are going to need to be stored. So typically that's going to be in a warehouse. In some cases, a retailer would purchase from a manufacturer and have it directly shipped to the retailer's retail stores. That happens sometimes where it doesn't go to a warehouse first. But a lot of times the goods will go to a warehouse until they're ready to be either shipped to a customer. So the goods can be, so if there's an order from a warehouse, let's say you make an order of something from Amazon.com, and then something goes from a fulfillment center and it goes directly to the customer. Or you could have a situation like, so for example, Walmart, another retailer, where they purchase something, they have it shipped to a warehouse, and then at some point it goes from the warehouse to one of Walmart's retail stores, and then at one of the stores, a customer decides to purchase the inventory. So the inventory needs to be stored, and security is important because employees, customers, people might want to steal inventory. Now, some types of inventory is easier to steal than others. If you're thinking about jewelry versus stealing an airplane. I'm not saying you can't steal an airplane. It has happened, but it's easier to steal a necklace or a ring than it is a 747. So we need to store the inventory, and then at some point the inventory is going to be shipped. Now, as I said, it could be shipped directly to a customer or it could be shipped to retail stores. But let's say it's shipped to a customer. Then the question is, so we're going to have the shipping order. So the shipping order is saying, look, here are the goods that need to be shipped. And then, okay, the people in the shipping department, they go and they assemble the shipping order and say, okay, here's all the stuff that needs to go in the box and we need to ship this. These are the goods that are being ordered and so forth. Question is, at what point is the inventory cost expensed? Because remember, so with a manufacturer, you have raw materials, then you have work in process, then you have finished goods. And with a retailer, you just start out with the finished goods. So either way, you've got this inventory, and it's not going to stay on the company's balance sheet forever. They need to expense it through cost of goods sold, COGS, right? And then when they debit cost of goods sold, they're also going to reduce the finished goods inventory. So when does that happen? Well, so it depends on the terms of the agreement. So let's say we're shipping goods from a warehouse directly to a customer. If the terms of the agreement are FOB shipping point, okay, if the terms are FOB shipping, freight on board shipping point means so we put the box in the truck and the truck drives away from our warehouse, as soon as we have shipped it, then the customer has title to the inventory. It's now theirs. It left our shipping dock, it's their problem. So if that's the case, then when the inventory is shipped, as that truck drives away from your warehouse, you're going to reduce finished goods inventory and you're going to increase cost of goods sold. Okay, you're also going to record sales revenue. But this, we're talking about inventory here, so we'll focus on inventory. So you expense the inventory when it's shipped. However, if the terms of the agreement with the customer are FOB destination, FOB destination means that title to the goods, title to that inventory, ownership of that inventory does not pass to the customer until the customer actually receives the inventory. Okay, if that's the case, then we're still going to record cost of goods sold and reduce finished goods inventory, but not when the truck leaves our warehouse. We'll record that when the customer receives the inventory. So the terms of the agreement with the customer dictate at what point we will expense the inventory. Now, I have updating inventory records listed as the final step here, step number 6. But as I mentioned earlier, you're actually updating the records throughout the entire process, because when you receive the inventory from suppliers, so when Walmart gets inventory that it purchased from Procter & Gamble, Walmart's going to make a journal entry. They're not going to wait all the way till the end of this process to make a journal entry. So when you receive inventory or raw materials inventory from a supplier, you're going to make a journal. The company's going to make a journal entry. When they transfer to the customers, as we said, whether it was freight on board shipping point or FOB destination, they would make once the title is passed to the customer, they make a journal entry. Then to expense the inventory, record cost of goods sold. When raw material, so for manufacturers, when raw materials are transferred into production, you decrease the raw materials inventory, increase work in process inventory. When the work in process inventory is completed, you reduce work in process inventory, increase finished goods. Again, these ones here are just for manufacturers. Now, I didn't talk about this a lot. I've got other videos on it, but if an inventory write-down is required, then the company would need to expense the inventory and then reduce the record an expense and then reduce the inventory account. I've got some videos on inventory write-downs if you want to learn more about that. But that also would require an update to the inventory records. Now, if we're talking about a retailer, remember that when they are expensing this inventory, they're not going to have, so basically a retailer is going to have to use a cost flow assumption, like first in, first out, average cost, or so forth, for determining what the cost of goods sold is. And I've got some videos on that if you want to learn more about inventory cost flow assumptions. So the retailer is going to use a cost flow assumption because quite often they can't use specific identification if it's a really large firm. If it's a manufacturer, they're going to need to assign the production cost using either job order costing, process costing, or a hybrid thereof. So job order costing, we're assigning production costs to jobs, job 101, job 102, and so forth. Process costing, we're assigning these costs to departments. So companies have these different ways of doing this, and so you'd have cost accountants who their job is to assign these production costs, and it can get pretty complicated. In fact, it can get even more complicated if the manufacturer uses something called standard costing. We say, okay, here's the standard cost per pound of inventory or per unit and so forth. Okay, and so standard costing is something you say, okay, here's the standard price we should pay, here's the standard amount of materials we should use to make the inventory. Why would a company do that? To be able to calculate variances, price and quantity variances for, did we get a good price on the inventory? Did we use too much inventory in production and so forth, which they would then analyze after their closing process once they've calculated the variances. Now, I've got videos on variance analysis, standard costing, job order costing, process costing. If you want to learn more about those topics, I just wanted to give you a basic overview of the inventory management process from start to finish.